This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and thanks for tuning in to this edition of the Alternative Investing Advantage podcast. My name is Alex Perny. Today on the download, the Federal Reserve representatives are moving towards ending the bond buying program that they have in place by mid-2022. This is a program that was instituted to help drive markets forward during the COVID recession of the past, call it year and a half. This essentially was the Federal Reserve moving towards buying U.S. Treasury bonds and bills to help keep those markets moving forward. Now, this is kind of the last of the COVID stimulus market support, so we'll kind of see where this goes with having the markets land on their feet, if there will be any type of correction. Now, this is one of those things that seems to drive inflation. Now, there are some concerns about that, although inflation has not risen to the level that some analysts think. The ending of this program will really see just how bad inflation can become after some of these measures are stopped and the markets get to stand on their feet for the first time in a while. Hopefully it doesn't move too bad of a direction, but it is definitely a concern for people out there. Now, also in the world of finance today, we're going to be kind of sticking with a theme of looking at what the government doing. The debt limit needs to be increased in order to avoid a government shutdown by September 30th. Now, what essentially this means is that in order for the U.S. government to continue paying its bills, we would need to borrow money. Now, currently, there is a limit set by the House and Senate for that. Now, the Senate needs 60 votes to advance the debt bill, which is highly unlikely that they will receive. They have a 50-vote simple majority, but in order for the debt ceiling limit to be increased, they would need to get at least 10 senators from across the aisle to come over to the Democrats, and it is widely believed that this will not happen. So the advancement of the debt limit spending bill is widely believed to going to be dead once the final votes are cast on that. Now, last week, we really covered in the download what was happening with the securities markets. Now, most of them have mainly rebounded from the shocks that they received last Monday, where we saw the Dow get hammered by 800 points. Most everything has rebounded, with the exception, notably, of tech. Tech is really still getting waxed out there. So it's kind of interesting to see, although some largely based tech companies are seeing quite an improvement in their share price, but it's not as good as maybe some of the market indicators would lead on. There are still some tech companies out there that are really hurting. This has been the download. Today on the What Is, the Consumer Price Index, or CPI. It's important to understand inflation as it relates to buying power of the dollar, especially when we're looking at a few of the market drivers that we covered today in the download, with the Federal Reserve moving their bond buying program to end by 2022. So it's important that we look at some of the things that measure this. Now, one great indicator is the Consumer Price Index, the CPI. It's a weighted average of prices, a basket of consumer goods such as transportation, food, and medical care. And it's calculated by taking the price changes of each item in the predetermined goods basket, is what people call it, and averaging them together. So it's looking at seeing how much your dollar can buy you from a fixed point of goods. Now, the most frequently used statistic for identifying periods of inflation or deflation is the consumer price index. So it's a good thing to understand if you hear people talking about the CPI, they're referring to the consumer price index, which is a weighted average of a price of normally consumed goods for American households. This has been the download. Thank you for joining us today on this edition of the Alternative Investing Advantage podcast. Today, we're going to take a special edition look at the Build Back Better agenda, which is the large Tax Reconciliation Act, which is currently being debated in the House Ways and Means Committee. I have our Director of Business Development here with us today, Scott Maurer. Thanks for being with us.
Alex, great to be here. Want to look at this bill has really kind of come out of nowhere, I think, and surprised a lot of people in our industry. And so, I think in the podcast that we really want to just get across some of the main provisions of the bill, things that our clients, contacts, people who are looking at alternative investing need to be aware of. And then most importantly, I think at the end is really how to act and how to fight back against kind of this overreach that we feel with this particular bill.
Yeah, absolutely. There's definitely some really troubling things in here that are really kind of tacked on that most people, if you don't kind of pay attention to this, will get more or less just not looked at by the general public, and can really have an effect all the way down to, John and Jane Doe taxpayer. It's really kind of troubling. So maybe give us a little bit of intro to this. What are some general provisions? Then we'll kind of dig into some of the more fine detail of this for people.
Yeah, and I think Alex, you hit the nail on the head there when we're talking about kind of the things that get slipped in the bill, right? There's always the headline catchers, and some of the general provisions in this bill you'll hear a lot in the media or hear from the congressmen and senators who are talking about the bill. When you talk about what raising the corporate tax rate or potentially raising income tax rates on high earners. Those are some of the big tax provisions that are being debated about. The step up in basis requirement, limitation or elimination of that. That's getting talked about as far as the taxes. And of course, this bill, we'll talk about what a reconciliation bill is here in just a second. But other provisions, on the spending side that are to clean energy. A lot of social programs, I think community college, universal community college and pre-K and things like that, there are definitely some probably good things. There are some good things in this bill. But it's when you get to the nitty gritty and you get to the fine details where the troublesome provisions come in and really affect, I think, have much far reaching impact than they think that was really intended to.
Exactly. And some of the things that we really want to try to make sure people understand is that a lot of kind of the news headlines are kind of pointing to, outlawing these mega huge Roth IRAs and traditional IRAs that you hear about, people talking about having, $1 billion IRAs. And there's a provision in here that would essentially cap single individuals from having a $10 million IRA or a household from having over $20 million in IRAs. I think most people, wouldn't necessarily agree or disagree with that being a bad thing. But the problem is that, when you read the text of this bill, or at least what they've put out to us so far, is that's just kind of the catchphrase. There is some very troubling things that go on behind the scenes of that. And we're going to get into that now. So maybe explain to us why a reconciliation bill is a little bit different from what people might have heard about before, and why it's a little bit concerning with how this can get kind of rubber stamped and pushed through so quickly.
Yeah. So just, a little bit of a kind of a political lesson here on how this works, and apologize to those your political junkies. Maybe I may not go in too much in depth for you, but a lot of bills that go before Congress when they're just general spending bills might have to pass with beyond a simple majority. That's when you hear people talk about the filibuster rules and the ability for the minority party to actually block certain legislation. And that happens, right? There's a lot of times when they need bipartisan support because they have to reach, say, a 60 vote threshold in the Senate. With reconciliation bills, though, and this agenda and act we're talking about is a reconciliation bill. The majority, it can pass with a simple majority, so long as with reconciliation that the taxes that are going to be raised by the bill, right? So we're talking about the raising corporate tax rates and income tax rises and things like that. As long as those taxes that are raised from the bill pay for all of the programs that are all the spending in the bill, in a sense, it's a net spend of zero. I know that's obviously, we know that's not going to ultimately be what happens, but if they can make it look that way on paper and have the numbers, that's why a simple majority can pass it. So that's where you don't need the help of a minority party, right? You can just go straight through as long as the net spend is zero. And that's the danger in this particular bill, is with one party controlling both houses of Congress as well as the presidency, they don't need help from the other side to make this bill go through.
Exactly. And what we want to make sure people understand is that we aim as best as we can to stay very apolitical here at Advanta. What we're really kind of championing here is just the context of this bill, how it affects you as the taxpayer, not necessarily getting into the background of, which party brought it to fruition, how it's being debated, is to explain to you that there's a very real chance that a lot of the laws regulating your personal retirement can and probably have a high degree of having some legislation passed that might change that. So let's get into some of the actual provisions. The one that I think a lot of people are kind of bringing up is the provision, and I'll read off the name of it, but it's section 138.312, a prohibition of IRA investments conditioned on account holder status. Now, when they're talking about account holder status in the context of this section, they're talking about being an accredited investor. So for many years, to be an accredited investor meant that you had to have certain thresholds of wealth, be it the amount of income that you made as a single individual or a household, a trust with a certain amount of assets, a corporation with a certain amount of revenues. So essentially what it did was try to help mitigate the risk of normal, John and Jane Doe from being involved in extremely risky investments that hadn't been qualified to be exchanged on the New York Stock Exchange or a publicly traded securities exchange regulated by the SEC. Now, a lot of people kind of view this as, a closed door to people being able to invest in, very, very lucrative investments. But in reality, it was meant to kind of shield people from some danger. But the problem is that the extreme wealth that these people were defined as back when the rules were initially written in the 80s has significantly dwindled. We now have many more people that are able to invest into things that they see fit as a good fit for them. And this is not just, a risky startup company. These are limited partnerships. These are, apartment buildings. These are all sorts of different things that are, defined as private placements. Now, maybe if you want to dig into that a little bit further, Scott, I said, a few different types of investments, but maybe dig a little deeper into, what this might mean for an individual, because we're not just talking about, Uber before it went public. It definitely trickles down to a lot more specific investments, right?
Right. I mean, there's, a lot of our clients and certainly a lot of people out there who self-direct. These are what they want to put their money into. It's, like I said, apartment buildings, it's multifamily syndications, it's private investment funds. It's startup companies where, the barrier to entry is that accredited investor status. And as you mentioned, Alex, it's something that, I think I read an article that when they first introduced accredited investor standards, it only encompassed, less than 2% of the population. Since it has never been indexed for inflation and obviously the growth in the economy, it's now over 13% of our population qualifies as an accredited investor. And furthermore, there's been changes in the last few years to the SEC rules that actually to allow more people to be an accredited investor. So it's really, in a sense, the movement has been towards allowing the average, more quote, average Joes and Janes to be able to access these types of investments and into startups and into multifamily and actually have more access to those investments that the, quote, mega rich or rich have presumably been investing in all along. So it's one of the interesting things with this provision in not allowing people to use their IRAs to invest in this particular investment. You're cutting off a lot of the people who are taking advantage of this that maybe haven't had access before. And I think, from our experience with a lot of our clients, people who are either just becoming accredited or right there, they're not rich per se. They don't have, millions and billions of dollars, but they have, nice nest egg that they built up. A lot of the money that they have to take advantage of these particular investments is in their IRAs or in their old 401ks. And you're simply cutting off those people from doing it. So the effect on the actual self-directed IRA owner is simply going to be more limited options instead of actually opening up more options for them to invest in.
Yeah, absolutely. And the other really kind of very troubling portion of this section particularly is that, all well and good that they want to prohibit this from being done, but they go even further than that and say that these assets have to be fully divested from IRAs within 2 years, beginning after December 31st of 2021, which is just an administrative nightmare for not only the investment that maybe had taken in IRA monies, completely above board, had done everything correctly, and the IRA administrators and custodians of how to, administer these types of changes. You're going to have people getting hit with humongous amounts of taxes because they had done something correctly. And now we're being told that, after the fact that the government changed their mind on the allowance of this within this type of tax shelter, and now they have to take it out. So, you're not necessarily penalizing the mega rich as, maybe the intent was here to try to level the playing field a bit. This boils down to people that make $250,000 a year. And if you live in Midtown Manhattan or, the San Francisco Bay Area, that is not an extremely rich person. That is someone that is living right in the middle of middle class. Now, granted, those people might be, much wealthier in other places, but it's not across the board that this is taking, these are not billionaires that this is going to affect. This is, significantly right in the middle of, some parts of middle America that this can actually affect.
Yeah. And the issue again, it's anyone who's currently holding one of these types of investments in their IRA account and they're, accredited investors, you have to get rid of it within 2-year period of time. So you're either going to have to hope, best case scenario, you are invested in a partnership that has the liquidity to simply maybe pay your IRA off and buy you out, or can place you with another investor, a substitute investor, and you're able to get your cash back. But even that scenario, if another investor is coming in to take your position and relieve you of that, are they going to give you full value? If I've invested $100,000 into a partnership and I need to get out of this without having tax consequences, somebody may come to me and say, well, yeah, I'll give you 70 grand for it, to help you out. But so I'm still losing in that investment. I think that's certainly part of the problem. So either I have to sell. So as the IRA owner, that's going to, I'm at the mercy of other people, or at worst case, like I said, I have to distribute it. And if I'm under 59.5, that's taxes and penalties for regular IRA investments. So, I think that's a key thing in the legislation. Obviously we want all of the provisions in this legislation to get out, but that's going to certainly hit people the hardest who are already invested.
Yeah, exactly. It's just one of those things where just looking at that part of the bill just boggles the mind, at least from our professional side of things, of looking at, how would you even implement this? It just, there's so many questions that revolve around it. And hopefully these kind of questions will be brought up when there's some debate on this, and, people, calmer heads will prevail and we'll see some of this removed. But again, this is why it's important for people to make their voices heard. Contact your senators, contact your representatives. We will be sending out the kind of rubber stamp letter that addresses a lot of these things. You can certainly use that. Feel free to type one up yourself and send it to them. But, we need to make our voices heard on some of these things in order for the representatives to know it's even an issue. Because when we're talking about the better part of $3.5 trillion of spending, this is footnotes within this text of this bill. This is going to be thousands of pages of legislation that are going to be produced, hopefully as soon as possible, so we can actually get this, because we're still looking at ways and means notes of this. We're not seeing full text of these bills. Now let's move on to another one. And I think this one might have specific interest, at least to a lot of even non-accredited investors, because it gets into what a lot of people like to term checkbook IRAs, or using single member LLCs or trust entities to invest in certain investments, mainly simply just for administrative reasons, for no other reason than just it makes it easier for them to administer the assets of their accounts. We see many people from accounts ranging from $50, $100, $200,000 utilizing these types of structures. So maybe, Scott, give us the 30,000 foot view of what 138.314 is.
Yeah, so 138.314 is really, like you said, it's gonna prevent people from acting. If it's your IRA invested into the entity, you can have you can't be on the board of directors, you can't be a manager of the entity. As you said, the big impact to a lot of people, as you mentioned, who are not accredited, right? So the first section we're talking about people who are purportedly, quote unquote, rich or whatnot, who are accredited investors. Now we're talking about people who are not accredited investors who, as you said, they've set up this LLC for their IRA to invest in, to buy rental properties, right? Or to make private loans out of things that are not within the scope of this bill. And being the manager of the entity just simply makes it easier for them to do it. So this provision would eliminate the ability for you to act as manager of your own LLC. So again, a lot of people out there who are just sitting idly by, investing in rental properties, investing in other alternative assets, using this structure, are now going to be affected by this bill. And again, the impetus behind this, and we'll talk more about it maybe at the end, is the $1 billion IRAs out there where there was some potential self-dealing and some other issues. But This is, to me, it's casting way too wide a net. If you were fishing for a particular kind of fish, but you cast a net that covers half the Atlantic Ocean, right? You're going to get a lot of other things in there than just the little bit that you're actually shooting for. So, that's going to be the effect on our clients and certainly people who have checkbook control. We don't know yet, again, how this provision is written, if it's going to be a requirement again that you divest yourself of that particular asset. Best case scenario, could you possibly choose somebody else to act as the manager and remove yourself? I mean, that might be possible. It might be hopefully an easy solution if this provision does indeed pass, which of course we hope it doesn't. But then again, now if you're doing a checkbook control, and now you're giving managerial control to somebody who is not you, and it's going to make it more difficult.
Exactly, and really, where does this kind of litmus test start and end? Because really, what's the difference if someone has, let's say, a brokerage account with, pick whichever big brokerage house you are, and they're picking stocks to trade on a daily basis. They're clicking buy, sell, creating orders. Really, what's the difference in that and in using a special purpose entity like that? And we've seen the tax court examine this, and in different aspects, they haven't maybe examined it specifically. They've been looking at other aspects of a particular case, but they have, in many instances, sided with the fact of the ability of an IRA owner to act as strictly a manager in a non-fiduciary capacity to their IRA investment. So
yeah, I mean, and that it's an end around the tax court, right? I mean, as you're talking about, the tax court has heard these cases, and non-political tax court making decisions in cases, and certain people not liking the results. So therefore, we're just going to make an end around it. So that's
exactly. And let's kind of get into some of the effects here. So getting back to 138.312, it's one of those things where it has really far-reaching implications, not just from a taxable standpoint, but just from a market standpoint, because the ability of people to raise capital is, paramount to the success of many of these small investment firms. People that want to invest and make communities better, that want to buy the, B or C apartment complex and turn it into an A property. The ability of them to market and solicit to investors and their retirement plans is huge. What was the last look at the total retirement plan assets in the United States? How many trillions of dollars?
Oh, 20 something.
Yeah,
right?
like 27 trillion dollars of retirement plan assets. And now this bill effectively would just remove that whole chunk of the marketplace from them, for them to only look towards things like traditional financing, forcing them back into traditional banking relationships, forcing them back into more narrow scopes of being able to raise capital. And one of the things that people may not realize, and again, our job is to kind of maybe enlighten people a little bit, is that the tax benefits, even to personal people, you're not making this great tax loophole go away for the super rich, but limited partnership investments, especially into large commercial properties, don't normally have a lot of taxes associated with them because of all the losses, because of things like cost segregation and depreciation that is passed through to the ultimate end investor. Even a personal investor with, relatively straightforward tax planning can mitigate a lot of the taxes doing it outside of that anyway. So again, kind of seemingly a moot point from the aspect of, maybe leveling the playing field or keeping people, especially the super rich, from being able to, only invest in these kind of cherry pick type of things.
Yeah, and I think, that drives it home too, again, Alex, is the fact that, if somebody's looking to raise capital, it kind of depends maybe where you are on that capital raising spectrum, right? You have people who probably have no problem anytime they put an offering out, they have so many connections, it may not affect them as much, right? Because they can get the money from wherever. They don't have to rely on just IRA investors. But for a lot of people, either getting started or kind of in that middle ground, where when you're looking to raise capital and you're talking to average folks, you're not going to big investment firms and investment banks for your money. And you're talking to average people that want to take advantage of your investment. Again, they may have the bulk of their funds to invest with you sitting in that IRA, sitting in that old 401k. And that's why they're choosing to use that money. That's where their funds are located. And obviously you as a capital raiser, you'll take it kind of from anywhere you get. And cutting off the IRAs from being a part of that conversation is really going to hurt those people, like I said, getting started. Maybe they've been going for a little while, but they haven't reached that status yet where they can just go to an investment bank and request a check for millions of dollars. it's going to hurt them. And by hurting them, you're hurting the people that work for them. You're hurting the, startup companies that are trying to, innovate and create new products and new services and looking to raise capital for that. It's going to have much far-reaching effects, I think, than certainly has been maybe intended in the bill, and certainly maybe even speculated at all to this point. So, as you mentioned, a lot of some of the investors who are already in that mega rich category, they're going to be able to take advantage of these investments anyway. So it's not really going to affect them. It's affecting the average person to have access to these types of investments. And then again, the people who are taking that capital in, I think they're going to see a loss in the potential toolbox that they have to raise capital for their upcoming investments.
You're really kind of reducing, and I hate to kind of be hyperbolic, but you're reducing the freedom of the investor to make an informed decision. Investing in the stock market is not the best fit for everyone. If someone doesn't understand it, giving them the option to invest in alternative assets, which is what we've done here at Advanta since the early 2000s, it's a good fit. And it's important that these kind of options are out there for people, because if you are just kind of forced into doing something you don't understand, you're not as informed as an investor. It's just going to be a harder uphill battle for you. But if you understand things like real estate and, private investing or something specific that you want to do, the ability and the freedom for you to do that is really important for, the average taxpayer to help, prop up their position for retirement. So, just kind of on that note, we'll kind of transition a little bit onto some of the slightly more speculative aspects of this. We have seen people out there talking about, well, will this extend into 401ks? We don't know right now. Again, we're still just going on the general cliff notes, if you will, that have been put out to us. So it would go to think that they're talking about IRAs. They might extend this to the broader scope of retirement plans. But scaling back, just the administrative aspect, it's hard enough to say, hey, an individual IRA investor, could you imagine, extending this into, a large 401k plan that maybe has private holdings in it? So, it's going to be kind of hard to see where they draw these lines.
Yeah. And it's the interesting thing, again, kind of taking a step back from it too. If the goal of some of these provisions is to, prevent certain individuals, certain rich individuals, whatever, from taking advantage of this or through IRA accounts, a lot of it, and definitely not making any judgments, but there are a lot of doctors, attorneys, physicians, whatever, who have their own defined benefit plans and have their own solo 401k plans with thousands or hundreds of thousands and millions of dollars. And if those types of plans, the defined benefit plans and the qualified plans are not included, then you're not hurting the individuals who you're really seeking to prevent from taking advantage of it. So, it's kind of just goes back again to one of our main points is just very poorly drafted, poorly thought out provision in the bill. And, will they include solo 401ks, people who are small business owners, people who are entrepreneurs? Will that be included in the final bill? We don't know. We haven't seen even a draft of the bill yet at this time.
Yeah, exactly. And another part about this whole reconciliation bill, it is tied to the other infrastructure bill out there as well. So, a lot of things that, all of these things being tied together is really unfortunate, because it makes it harder for your politicians that are advocating on your behalf to negotiate. If everything is tied up in one bill, it's harder to say, oh, well, we don't like this one bill or this, that, or the other thing, because, oh, well, it might be tied to a huge, a part of the bill that's going to create millions of jobs or lots of jobs in your district. So, what's the weight and the benefit? You can't necessarily advocate for all of the best things for your constituency.
Yeah. And I think the political speculation, it's, there are two separate bills. So it's not, passing one passes the other, but there are, politicians out there that are tying their votes to both bills as it is. And so they're making it difficult. There's another infrastructure bill that has bipartisan support that has already passed the Senate. It's simply waiting for the House to pass that particular bill. But there are certain individuals that are saying they refuse to vote on that bill unless this particular $3.5 trillion bill is agreed to without changes. So it'd be interesting to see how that plays out. There are definitely a lot of more moderates in the different caucuses with the senators and representatives who have thrown up a lot of objections to the size of this bill and have come out and so far at least said they're not going to vote for it at that current price tag. So I think, again, the key thing to watch for us and certainly for the self-directed investors is what's going to be the timing of it. Is it gonna pass in its entirety? Highly doubtful that it would pass at the 3.5 trillion. I think that's almost a given that it won't pass. But will it pass at a much lower number? And if it does, certain things are going to be cut, removed from the bill to get that price tag down. This obviously is a provision that we'd want to see removed. And the ironic thing, I don't know if we really mentioned it so far, when you talk about raising the corporate tax rate and raising income tax rates, and raising the higher tax brackets, that's where the bulk of the spending, bulk of the taxes is going to be coming in from this bill. These particular provisions, with these two provisions we're talking about, are expected to raise less than $2 billion in taxes on a $3.5 trillion bill. So it's less than 1% of the taxes raised is coming from these provisions. So it's not even a drop in the bucket, right? It's so little of the overall bill. So it'll be curious as they start to cut the $3.5 trillion, what gets cut to get that bill down. Certainly we're hoping, and I wouldn't know if we're expecting it yet, but I'm really hoping that there's going to be enough outcry and pushback because again, these provisions of the bill are reaching far beyond, I think, who they're intending to punish or rein in. We think, from what we've heard, a lot of the reasoning behind this bill are the $1 billion IRAs. There's a gentleman by the name of Peter Thiel. Many of you may be familiar with him, who owns PayPal and started PayPal and built billions of dollars of wealth inside his Roth IRA from investing in his own PayPal stock. And he's a little bit of a nemesis to some political parties and political figures that ruffled some feathers. And part of these bills, and I think the provision, Alex, you mentioned on the capping of the total value in IRAs is certainly directed at him. Mm-hmm. And I think some of these provisions as well, though, are in that same vein. And Mitt Romney has a $70+ million IRA as well. There's the founders of Google are in that same boat. So it's I think that's kind of what they're going after, but they're catching way too many people in this net.
Yeah, and also keep in mind that there's also part of these tax bills we didn't even get into because it doesn't it's not super central to self-directed, but there's also changes to Roth conversion rules and a lot of other things. So it's very important to understand that if this is kind of giving an inch and people are going to take a mile when they start legislating, the types of allowable assets within these types of plans. Keep in mind, there's already rules on self-dealing. Granted, the Peter Thiel's, I would be interested to see if the IRS, did an audit and examination if there wasn't, some issues with how those shares were acquired. But the IRS already has rules on self-dealing, on selling IRA assets, selling personal assets to IRAs, and these types of rules have been in place since the 70s on, what types of allowable investments there are. And by intentionally leaving it vague, they have allowed for people to create fantastic nest eggs for themselves that help reduce the burden on things like Social Security and retirement. And, now starting to have the government take some of these things back, it's kind of frightening to see where these things might go. So just keep in mind that although, we don't have time to kind of go through every provision of what we've seen from the Ways and Means on just the finance side of things, there's things that are, being tacked on here that are extremely troubling that, given, a little bit more detailed look, which you can find on advantaira.com. We have, a little bit more detailed analysis on some other stuff. We also are sending out a letter that you can send to your representatives and senators of being a call to action on trying to have some of these things, removed or debated more. So keep in mind that, the action and the responsibility is now kind of placed on us as the investors to say, hey, this is not in our best interest, and letting our representatives know. Past that, is there anything else that you would recommend people, get out there and do to try to bring attention to this?
Yeah, I think ever since our founding of our country, right? If you're unhappy, contact your representatives, contact your senators. They are there, supposed to listen to us. And, I'm sure at times that doesn't happen. I don't want to be naive about that, but I do think that, one thing they do care about is keeping their jobs, being reelected. If you're someone who is in a district where somebody might be up for reelection, obviously the representatives are always up, but people who face a tougher battle, they're going to be more likely to listen. And I think that they do. And I think if enough people continue to contact them regarding it, it sounds, like I said, it sounds a little silly and naive. I would just write your congressman. I think it works. If enough people are doing it, I look at it from the perspective too. If you think of a larger issue of, say, the raise in corporate tax rates, I'm sure the Congress people are getting emails and correspondence from people who say leave that corporate tax rate alone. It's already at where it needs to be, and they're getting other letters that say raise it higher, right? So they're hearing from both sides of the aisle on some of these issues, and from their constituents. On this particular provision, I don't think they're going to get very much at all of people saying, yes, please keep these provisions, please increase let's make it a little broader than it already is. That's not going to happen. So I think the power of the people to actually say, hey, these provisions, not fair, far reaching, you're not even accomplishing the goals, so quote unquote, of what you're trying to accomplish with this particular bill. So I think writing those people, telling your friends and neighbors, thinking, even if you think that, I'm not an accredited investor, I don't have a checkbook LLC, why should I care? If you're a self-directed investor or you're someone raising capital, we don't know where this goes from here. If this passes, what is the next bill going to include that does include you? And because you didn't speak up and make your voice known on this to kind of stop them in the tracks now, what's going to come in the future? And it's not really a fear tactic. That's a concern, obviously, is where if they have a problem with self-directed assets and this is their first salvo, and then after that they see what they get and move on.
Exactly.
It could be your account that's in jeopardy.
And this just pushes everyone back, it's funneling everyone back into stock markets. And again, that kind of going back to what I said earlier, if you don't understand it, maybe it's not the best fit for you. And we just saw on Monday, we had the Dow fall 800 points, having its worst day since October of last year, predicated largely on a Chinese real estate investment firm not making its loan payment. So, you're being exposed to risk and market fluctuations like that. So just keep that in mind that, we have the ability to do things. Contact your representatives. If you have any questions, feel free to reach out to us. Anyone here at Advanta is always happy to answer questions. We've been, fielding calls constantly since this stuff came out. So, we're here to help, get you the good information that you need to make informed decisions and try to help you on the right path. So thanks everyone for joining us today on this special edition of the Alternative Investing Podcast. Thanks, Scott, for being with me today. I really appreciate it.
Hey, no problem, Alex. Happy to get the word out on this. And yeah, I'd go beyond. Contact your reps, contact your centers, tell your friends, tell your family to do the same thing. The more, the better.
Yeah, exactly. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.